Welcome, everyone, and thank you all for joining us today in this expert discussion as part of our ongoing technical webinar series. My name is Yaeli Rosenberg. I'm head of biology at eConcrete with a PhD in marine ecology and a coral specialist. Today, we welcome three experts to discuss marine nature markets and how evolving regulatory frameworks and finance models are progressively linking ecological performance with investment decisions, also risk profiles and long-term asset values. So a little bit of housekeeping items before we start. Everyone that has joined this webinar is on mute. The webinar is being recorded and will be available online afterwards. The session today will be composed of three presenters, 10-minute presentation each. And please use the Q&A window to ask questions. We'll take a few very short questions after each presentations, and we will have a discussion at the end of the presentations. We all know that nature markets are moving beyond carbon, with biodiversity credits and mitigation banking translating nature into measurable and investable assets. In parallel, we see that financial institutions are assessing and integrating nature-related risks and opportunities into investment strategies. Instruments such as blue bonds and sustainability-linked loans are creating practical ways for marine stakeholders to finance and deliver outcomes that strengthen resilience and long-term value. We will start the webinar with a presentation from Dr. Ruth Dagan. Ruth is a partner and head of environment and climate change practice at the leading law firm Herzog, and Neeman. Ruth recently concluded a 3-year term advising the UN Framework Convention on Climate Change. She's also the co-chair of the International Emission Trading Association Legal Working Group and a member of Vera's Expert Advisory. Ruth specializes in carbon markets, climate policy, and the intersection of regulation and finance, advising global stakeholders on innovative climate solutions. Ruth, the floor is yours.
Thank you, Yaeli. I'm really happy to be here. Thank you for having me take part in this webinar. And if you can start sharing my slides, great. Thank you. So what I'm going to be doing today as the first speaker is talking to the main trends and developments that we are seeing really develop very strongly over the past few years regarding the process that nature and biodiversity is going through with respect to taking value as a financial asset. And what do I mean by that? It goes to the very well-known adage of never let a good crisis go to waste. And what we're seeing here basically is that corporations and financial institutions are realizing that nature and biodiversity are a major risk to their activities. And being a major risk to their activities, that actually means that they have financial value and can be leveraged as a financial opportunity. And that is what we're going to be discussing today, essentially. Now, before I dive into what exactly exists within this ecosystem today, I'm going to refer really briefly to the actual crisis, the nature and biodiversity crisis. And what we're seeing are really staggering numbers. We're talking about approximately 60% of global GDP that is moderately or highly dependent on nature. And what we can see here in the image that is illustrated in this slide is that basically most sectors of the economy are to a either high or moderate degree exposed to risks relating to nature and biodiversity. And we're seeing this not only in the, I would say, usual suspects of forestry, agriculture, and so on, but really seeing it throughout the supply chain within the electricity sector, water utilities, food, of course, any type of supply chains and transport. So we are seeing the heaviness of nature and biodiversity elements weighing upon the entire economy, essentially. Next slide, please. So now, before I dive into the actual frameworks and financing tools and some examples, I want to stress a very important principle that we work under within our team with respect to this ecosystem specifically, and that is the fact that when you are looking at any type of framework or policy or guidelines or regulations relating to nature and biodiversity, and you're looking for types of incentives or tools that can speak to the marine space and to any type of activity that is related to the seas, essentially, you don't need to look for this specific terminology. Many, and in fact, most of the frameworks automatically apply there. And then it really becomes a question of regulatory and legal analysis of the scope of applicability of each framework. But generally, you can really do not discount anything that doesn't explicitly say marine on it, okay? That is really an important message for you to keep in mind as I go through my presentation. Now, in terms of major international frameworks that address these types of spaces, it's really tough to choose. I've chosen the three that I think are the most important ones, the most dominant ones. Then, of course, we are talking about the Kunming-Montreal Global Biodiversity Framework from 2022. This is a major and quite historic agreement by close to 200 countries that have reached consensus on action that needs to be taken to address nature loss with targets up to 2023 and later. And actually, they do feature various high-level tools. I'm going to talk about one specific one, which is target number 19, because that particularly is relevant for financial markets, and that target explicitly calls for mobilizing private capital and innovative financial instrument to close the biodiversity finance gap. And we're going to be talking in more granular terms and illustrations about this a little bit further on. Now, the MDB Common Principles, this is a gathering of 10 multilateral development banks tracking nature finance and linking poverty, climate, and nature loss. I think it's a well-known fact and really can't be contested that all of these elements are very closely intertwined and have a lot of synergies and cross effects. And we will also be seeing this, for example, through the fact that, in my experience, carbon markets can too be utilized for various nature and biodiversity projects, and there are a lot of intersections there. So that's just an example. Now this framework by the multilateral development banks, in my view, is very important because it gives a foundation for what the entire financial sector is going to be doing. And I really encourage everyone to look at that. And then finally, we have a framework relating to biodiversity credit development by several prominent international organizations. I'm not going to be talking too much in detail about that. That is going to be discussed by my colleagues here in a minute on this webinar. Next slide, please. Okay, so I think that one of the main elements that it's going to be really propelling this space forward is the fact that we are seeing biodiversity and nature element being ingrained within corporate disclosure requirements. And again, here I brought several prominent examples that through this lens, we're going to be seeing corporate action, because whatever corporates need to report and disclose, ultimately they're going to be taking action on. So for me, the main takeaway on these frameworks is the fact that with all of the discourse that we are seeing over the past, I would say, year or two regarding ESG and sustainability and so on, the main message becomes that everyone is looking at the substance. They're less looking at providing, I guess, all kinds of glossy projects and targets and frameworks for corporate action. They're looking to really internalize these concepts into corporate organizational structures and strategies. And it becomes really about the subject matter in its essence. And here what we're seeing, I'm going to really run through this very quickly. The CSRD, this directive has undergone major changes recently through the omnibus. However, it is very important to take into account that we have a specific element regarding biodiversity disclosure that is going to become binding in 2027. And for those of us in sustainability work, we know that this is literally around the corner. It's like a minute from now. So corporates really have to start aligning with that. Along with that, we have the TNFD framework, which is in a sense voluntary, but if I bring the UK example, then you can see that actually TCFD aligned disclosures along with the TNFD disclosures are becoming mandated for public sector entities. The GRI framework, which is a voluntary framework that is very common for ESG reporting around the world, has actually published and updated standards for dealing with biodiversity in 2024. And I would say the major development in this space is the ISSB that is working on standard setting for nature-related risks and opportunities. And this is due to be coming out towards the end of 2026. Next slide, please. Now, we're also seeing this translate into practice, into actual financial instruments and capital raising and debt raising. And some really prominent examples. One is actually from the blue bond space. However, again, I remind you, you don't have to have this heading for a project to actually be able to apply it to the blue space. And one of the major, very interesting ones by Ørsted is an issuance of 100 million euros blue bond to fund marine ecosystem restoration near its wind farms. That is super interesting. I think it's going to be a trend that will become quite strong in coming years around infrastructure. Goldman Sachs took this a step further by creating a biodiversity bond fund. And the example of Ørsted is, of course, perfect for that type of fund. And then another very prominent tool that is developing this sustainability-linked loans. And here we have the example of Iberdrola, which had a loan of $2.6 million tied to reducing water withdrawal from power production. And that, again, is a really good example of the utilization of this type of tool. Next slide, please. Now, we're seeing institutional investors and the banking sector coming in strongly with strategies and policies. I'll just mention very briefly BlackRock and UBS that have very granular strategies around this space, including board oversight of activities and really becoming involved in innovation and R&D and looking at supply chain due diligence. So really every possible level of institutional investor action, we are seeing their involvement in this specific space. Next slide, please. Okay, just a mention of one of the main resources that I would recommend looking at in terms of, okay, how are we translating all of this potential and all of these opportunities into actual tools. And here we have a leading resource by UK Climate Financial Risk Forum. And what we have here is actually, again, the heading might be misleading, but there are actual nature-related discussions within there and specific tools that relate to how effectively we can translate these opportunities into our own business models. Next slide, please. Okay, now I'll say a word before concluding about the credit markets, and here my colleagues are going to speak to this in further detail. I would have to say that the biodiversity and nature market, that is still a budding market, that is true, but it can really make very significant and quick strides, in my opinion, building upon lessons taken from carbon markets. So there have been major developments, major tools, and major science that has the backup of pretty serious registries and standards within the carbon market that can serve as a foundation here, and also some tools that are very significant from Article 6, which is the international carbon trading mechanism by the UNFCCC. For example, the Sustainable Development Tool, which can essentially be utilized for these types of markets as well. And I will, of course, mention the EU roadmap for nature credits that is developing as we speak. And I really would like to draw everyone's attention to this, because this is going to be a major, very relevant framework for developing these types of markets. Next slide, please. That's going to be my conclusion. So I would say my key takeaways, of course, as I said, there is a growing urgency that has been formally acknowledged by the major corporate and financial actors within the global economy. And we're seeing emerging policy and legal frameworks around that, diverse financial instruments. And for me, the strongest signal of maturity is the fact that the major financial players are really coming into this space and taking actual action. This is the best signal that this space has financial potential and really can be a game changer for young companies that are developing technologies and projects within the nature and biodiversity space. That's me. Thank you. Thanks, everyone.
Thank you, Ruth. It was a really thorough overview of all the regulatory drivers for these markets. We have a few questions from the audience. We'll start with the first one. Let's see if we have time for another one. What lessons from the carbon market can we apply to the emerging nature and biodiversity markets? And what mistakes must we avoid repeating?
Yeah, thanks. So I was hoping for that question, actually. And I think that having been in the carbon market space for quite some time and having been actually involved in the drafting of the mechanisms of the UNFCCC framework for Article 6, there are definitely many, many lessons to be taken. And there is no need to repeat historic mistakes. But I think that definitely what I would look at is the fact that there is need for very clear rules and standards for everybody to gather around. That is a must. And of course, clear rules on measurement and quantification. That would be something that is very challenging within the biodiversity and nature space. But I think that at this point, because digitization has become so advanced and we have blockchain and AI tools and essentially a lot of new technology that has not existed before is coming into play, that can really be utilized to create a market that essentially just a few years ago was not even possible. Yeah. Thanks.
Thank you. It was very interesting. And we don't have time for another follow-up question, but you will be asked questions at the discussion part. So thank you for the presentation. And now we welcome Simas Gradeckas. He's the co-founder and CEO of BloomLabs, a biodiversity credit market intelligence platform with the most extensive voluntary biodiversity market database. Simas is involved in the development of biodiversity credits internationally and especially at the EU level. He contributes to one of the EU-funded projects piloting credits in European wetlands and is part of the Commission's expert group on nature credits. Simas, you can now present.
Awesome. Thank you so much, Yaeli. Give me just a second. Here we go. Let me know if you see my screen.
Yes, this is great.
Well, thank you very much. Thank you for inviting me over to share a couple of thoughts about nature markets, especially in the marine context. You, Yaeli, just saved quite some time and allowed me to skip this slide by sharing a better introduction of myself than I could. Thank you very much. Indeed, we focus on biodiversity credits and have a market intelligence platform that basically tracks every meaningful structured data point for the voluntary biodiversity market. Two key, let's say, developments are the credit schemes. We keep track of over 50 different voluntary credit schemes and analyze them across 50 different data points. And we track the market activity. So market transactions, suppliers, the buyers, and the projects taking place all over the world. And I will share a bit more about that in just a minute. So very quickly to dive a bit deeper on the introduction to biodiversity credits that Ruth has shared. A common question we receive starting this conversation about biodiversity credits is, what is even a biodiversity credit? So the official version, let's say, is a biodiversity credit is a certificate that represents a measured and evidence-based unit of positive biodiversity outcome that is durable and additional to what otherwise would have occurred. So that is the key definition that the industry has adopted for the most part, which is great. Voluntary industries tend to have trouble standardizing. This is one definition that basically everyone stands behind. Now, you can think about it as a standardized unit of biodiversity gain or avoided loss. And it can take a form of a certain outcome or activity over a certain area for a certain time period. So let's take an example. It can be a 1% increase in a basket of different biodiversity metrics, let's say 5 to 10 metrics, over 1 hectare for 30 years. And that is a single, let's say, biodiversity credit unit. Now, the difference between biodiversity credits and carbon credits is that these three variables, outcomes, activities, area size, and duration, are non-standardized in biodiversity. So you'll have different outcomes, different area sizes, and different time periods, meaning that every single credit scheme almost will have a slightly different credit unit that they issue. So we don't have a standardized, let's say, liquid marketplace, or we don't have the foundations for that at the moment for biodiversity credits. But basically, every single credit can and does follow such a structure. Now, let's take a look at the present state of the market. This is the latest estimate by the United Nations Environment Program on the finance flows, both from the public and private side. Historically, and still to this day, public finance dominates. However, within private finance, biodiversity offsets and credits is the largest section and the most, let's say, the highest potential section to grow in the future as well. And it's been estimated that the market size for biodiversity offsets and credits is $11.7 billion. We're also seeing consistent growth in the biodiversity offset program. So according to OECD and their data in 2024, there's at least 17 biodiversity offset programs across 9 countries. And these are programs. These are not necessarily markets. These can be project-based offset programs where land developers maybe might need to, on a per project basis, offset their impacts. However, we're also seeing the emerging biodiversity credit policy frameworks at the national level. So there's at least 16 compliance biodiversity credit markets being developed or in action. The largest markets at the moment are the US and Germany. They are virtually 90+% of the total market size, followed by Australia, Colombia, and now, as of more recently, England as well. We're also seeing progress at the EU level, both at the bloc and national level. So as Ruth has mentioned, the EU has launched their nature credits roadmap last summer, and from 2025 to 2027, they should develop the next steps and the EU's position towards nature credits. Nothing is certain yet. The expert group has just kicked off last month, but we're very excited about where this can take the market since the EU is taking the lead at the bloc level. However, we're also seeing countries take initiative themselves. So France, Finland, Germany, Sweden, England are all examples of that, where countries develop their own voluntary biodiversity credit schemes or compliance-based, but these are highly interconnected. Now, the key point here is that the compliance markets make up 99.9% of the market for biodiversity offsets and credits. And all of the compliance markets are based on offsets virtually. Voluntary biodiversity credits are not based on offsets. In comparison, they're based on contributions, or let's say nature positive contributions. And they are virtually, in comparison, non-existent. They are just a drop in the ocean at the moment. This is a screenshot of our platform, BloomLabs, that gives a quick overview of what the current state of the voluntary biodiversity market is. As you can see, top right, we have almost 10 million in verified voluntary biodiversity credit transactions. Actually, we have 12 to 15, just not all of it is yet on our platform. Still, the number is minuscule. And as you can see, most transactions have taken place in the past few years with slow but steady growth in new transactions each quarter. Now, we have over almost 1,500 transactions on our platform. 90% of these are consumers. So there's platforms that sell biodiversity credits where anyone can purchase them. And so far it has been, let's say, a testing ground just for individual consumers who want to contribute. Companies, as you can see on a bottom right, on the bottom right, are only a small part of the total pie. And even within the companies, most of them are SMBs, smaller than 250 employees. We have a couple of dozen, let's say, of large corporate B2B transactions that have taken place. Most of them are test transactions, small sizes or undisclosed sizes, which then probably mean that they're small, but there's some toe dipping happening from the corporate side. A lot of times these corporates, instead of buying themselves, they will fund an NGO to buy credits or use their own foundation. They're in test mode and they're very cautious, especially given what's happening at the voluntary carbon market. Now, if we look at the top developers by sales, and I do not know if you see my cursor, the number one project developer is Niue Ocean Wide Trust, which actually is selling ocean conservation commitments, which is 1 square kilometer of conserved ocean for 25 years, one of these credit units. So marine project developers are actually some of the leaders, but it is a bit of an outlier. The majority of developers are based in terrestrial ecosystems, and especially in forests, and still the marine ecosystems have very few players who are really focused on biodiversity credits, let's say. Now, to very quickly structurally compare the voluntary compliance markets, obviously the number one difference is the mandate. Voluntary is voluntary, and compliance you must comply with, which directly affects the rest of the structure. So For the voluntary credits, anyone can be a buyer, as I shared some of the categories. We also see foundations investing or buying biodiversity credits, and even smaller traders, investors who are pre-purchasing or purchasing credits to then sell them in the future. However, the secondary markets are not robust yet for the voluntary biodiversity market. On the compliance side, we basically have anyone from the private or public sector who develops land and infrastructure and needs to compensate for these developments. As you can imagine, anyone who complies with this description can potentially be a purchaser of biodiversity offsets in the compliance side. Now, on the demand driver side, for compliance, very simple. It's a legal obligation. For the voluntary space, it's still unclear. We have some different reasons. Some are policy support. For example, you'll have a French compliance biodiversity market being used for voluntary purchases. The same thing will happen in England, where the trust of the compliance system is used to then just sell voluntarily or issue credits voluntarily for buyers to make sure that they trust the system a bit more. You'll have stacked and bundled biodiversity credits together with carbon credits being sold. Philanthropic purchases are very common. Projects that have a very specific local community impact will also have more popularity. You'll have biodiversity credits who are sold together with other products, such as event tickets or any other products. However, the key demand driver that everyone talks about for the past few years, or let's say the holy grail, which is nature risk management, that is not the case yet. Biodiversity credits on the voluntary side do not address nature risk directly and do not yet play an important part. And hopefully that these nature accounting frameworks will create this link between what the companies need to report and how biodiversity credits can play a part in showing that nature impact also has an impact on the bottom line for these corporations. At the moment, that is not yet the case. And obviously the market size is a huge difference. And for the voluntary side, the credits are priced primarily on costs to develop these projects. They don't have any pricing power beyond that. And for the compliance market is basically the cost of not complying, which is the price driver. Now, very quickly, let's take a look at what can happen in the future. This is the famous Paulson Institute study from 2019 that has started this conversation around the nature finance gap that was 700 billion back in the day. Now it's close to $1 trillion. And there was a lot of expectations that biodiversity offsets will be that difference maker in the next 10 years to bridge that gap, growing from 6 to 9 billion at the time to over $160 billion. However, that has not panned out as we can see from the latest numbers. We're not on track to meet these targets. And we have to understand that markets is one tool we know how to work with, and that is one tool that can scale. And both at the policy level, internationally and nationally, it has been relied upon heavily with mixed results, especially given the current state of the world. A lot of this is being pushed aside, and nature finance is not, and biodiversity offset mechanisms are not growing in par to the requirements. However, it's still likely to play a significant role. For example, COP 16.2 and the goal to increase biodiversity funding to $200 billion by 2030 does rely on biodiversity offsets becoming more viable. And as we can see, the compliance markets are growing, but the demands from the nature side are much larger than that. Now, the voluntary markets, this is the same chart that Ruth has shared. So I will only say that the estimates for the voluntary biodiversity market by 2030 to reach 1 to 7 billion, or by 2050 to reach 6 to 180 billion dollars has so far is not panning out. The key thing is that this is a voluntary market, and unless you have very clear commercial, let's say, reasons to purchase credits, they will always in the hierarchy of priorities will be pushed down, and if other needs are becoming more important, voluntary markets will suffer. So it's difficult to expect such market growth without policy levers being pulled as well. And that brings us to a fun case study from our side, from our work at BloomLabs. We're part of a 2-year EU-funded project to test out biodiversity credits for European wetlands. And we are doing that for primarily 3 ecosystems: peatlands, salt marshes, and floodplains. The reason I mentioned this is a lot of salt marshes reside in the coastal areas, and that is where the EU also wants to invest in. Our job for this project is to assess and select the right credit schemes for the context and develop projects and showcase that they can be both environmentally efficient and effective and economically viable. And for that, we have an associated partner, Volkswagen Financial Services, who has agreed to purchase the credits that will be issued. We don't know when exactly and what kind of credits, but that is the agreement. And we do hope that this will be an important proof point for the EU and for the wider market to see that we can use voluntary biodiversity credits as a tool to finance such work. Now, a couple of final thoughts. I hope I'm not too over time. Marine and coastal voluntary biodiversity credits are at least 2 years behind their terrestrial counterparts. So out of 50 plus credit schemes we keep track of, only 4 are solely focused on marine and coastal ecosystems. We need more experimentation on that part, but obviously folks here know that the marine and coastal ecosystems come with their own set of challenges that sometimes terrestrial ecosystems do not. And again, if there's no immediate business case around conservation, voluntary mechanisms are still limited, and policy support is crucial, especially for marine and coastal areas. That is why the compliance markets and the voluntary markets, they're tied at the hip, and we need one to work with the other for us to really scale private and public nature finance in that case. And we wish we saw more experimentation between biodiversity credit schemes, so mechanisms to issue these biodiversity credits, and purely commercial nature-related activities. So for example, coastal protection, or with activities that have a very strong commercial, let's say, commercial background. So coastal protection, tourism, food and material production. We wished we saw more schemes that really focus on impacting these activities, and then also quantifying the biodiversity outcomes while really focusing on coastal protection, for example, or ensuring that food supplies are impacted positively through these interactions, and really connect the pure commercial economic value with biodiversity outcomes. That has not happened yet, and I wish we just saw more experimentation. That is a completely new, novel area. And again, the results of the EU Nature Credits Roadmap are likely to dictate the future of biodiversity credits, both in the EU and globally, because a precedent still has not been set on how these markets will develop further. Thank you very much.
Thank you, Simas. It was very interesting insights and also practical overview in a real-world project. Again, we have time for one question. So, what, in your opinion, is needed to increase the share and scale of voluntary nature markets compared to compliance markets?
Yeah, that's a great question. I think, as in most voluntary markets, voluntary and environmental markets, you're buying and selling something that you cannot necessarily touch, grasp, or verify, and that makes it inherently difficult to then build trust between the counterparties. And that is exactly what we need. So we need, for that to happen, we need what I would call, let's say, a benevolent dictator, someone who really standardizes the main concepts, key activities, key areas where biodiversity credits are used and are not used. And, that will not make everyone happy, but it will really kick off actual, let's say, infrastructural or activity at scale. And I wish that someone would take up that mantle. Obviously, very tough for voluntary markets. Now, Biodiversity Credit Alliance, for example, is a UN-backed organization that can play that role and does in a way. But for example, the EU and their work on nature credits can play that crucial role in setting key standards, standardizing them, maybe standardizing a credit unit, maybe standardizing key indicators for key ecosystems that will be used and that other credit schemes will align to. And if we just have that slide standardization and trust building, that would help immensely. Because right now, it's easier to say no than to even explore the market if you're, let's say, a potential buyer, because there's so many risks. So you can't honestly expect them to invest a lot of time and effort and resources if the negatives are so apparent. And we need to minimize that. We need to minimize excuses, let's say. And nature accounting is doing a lot of that, both voluntary and compliance based accounting mechanisms. But we also need to go beyond that with biodiversity credits themselves and just act as a common unit as an industry.
Thank you. And now we welcome Dr. Catherine Jadot. Catherine is a marine biologist with over 20 years of experience and a blue finance specialist. Currently, she's leading blue finance initiatives for European and international institutions, including multi-country investment facilities, technical assistant programs, and innovative financing mechanisms for coastal and small island regions. Catherine will present.
Thank you, Yaeli. Perfect. Good afternoon, everyone, or good morning, depending on where you are. So I'm Catherine Jadot, and I work on blue economy and blue finance project with government, startups, and also investors, mostly on the practical side and really helping turn, coastal and marine priorities into fundable projects. So Dr. Ruth just set up nature and biodiversity risk and policy, and Simas just spoke very eloquently about blue carbon and biodiversity credits. And I would like to take just one step back and just clarify what we mean actually by blue finance, because this is something that we hear all the time. If you want to go to the next slide. So blue finance, it's really, the term blue finance at its core is not something new. It's not a new financial system, right? It uses existing financial tools and to fund activities that depends on healthy ocean coasts and water systems. So what makes it blue is not the instruments that we're going to use, but really the purpose and the way risk and impact are managed. And this is key. So blue finance is not the same as traditional development finance, right? Because even when similar tools are used, blue projects often involve longer time horizon, more complex governance, and higher exposure to environmental and regulatory risk. And this is very important. And second, blue finance is also not the same as climate finance. So sure, there is a lot of overlap between blue finance and climate finance, but marine and coastal investments will have different risk and revenue profile. And this is also key for the investors that will invest and finance the project. So when we talk about blue finance, we are really talking about applying financial tools that exist to marine and coastal priorities in a way that makes sense, and that makes those projects understandable and credible for investors. Next slide, please. So let's have a quick look at who is in the blue finance ecosystem, right? Because we need to find the right kind of partners when we want to finance a project. So at the very top, you have public actors, so governments, development banks, and multilateral institutions. So their role is really not to maximize profits, but they will set directions. They will also absorb risk, not all of them, but some risk, and make project really possible where capital markets would typically not go alone. Then at the bottom right of the slide here, you have private actors. So this is commercial banks, institutional investors, and that type of stakeholders. And this is where most of the capital sits. This is where there is the largest potential, right? But this capital is very selective because it's going to look for clarity on the risk, on the returns, and on the rules of the project or the frameworks. And then in between those two actors, you have hybrid actors. So this is more like development finance institutions, impact investors, and concessional facilities. So these actors are really critical because they help translate priorities into structure that the private capital can actually engage with. So what moves between these actors is not just money, right? It's also policy, risk sharing, and credibility. And when we see those three actors aligned, this is when we see capital flow the most efficiently possible and really to a broader range of projects. And when they are not aligned, what we see is that finance may still happen, don't get me wrong, right? Absolutely. But it tends to concentrate on a smaller pocket of projects that are familiar to the investors, that are a lower risk investment, and that leaves many coastal and marine priorities unfunded. Next slide, please. So once we know who is involved, the next question is, what are the tools of blue finance? What can we actually use? And in this slide, you have the main blue finance tools that we have in the toolbox. But none of these instruments are really new, right? We have grants, loans, bonds in other markets, and they're widely used very successfully in different sectors. But what matters here is not the tool itself, but how and when it is used. So this is really where structuring becomes critical when you think about funding your project, right? And this is also a lot of the work I do at the moment, because those tools are rarely used in isolation. So over the lifetime of a project, you're going to use more than one tools to finance your project, especially if you have like a project that needs a lot of capital, like an infrastructure project, for example. So, for example, you might have grants at the beginning of the project to support, feasibility studies or project preparation. This is not something that typically an investors will invest in. That's why you need grants. Or those grants, technical assistance might help to make a project more bankable and attract more investors. So the key question here in blue finance is not which of these tools do I pick, but it's more which combination of tools makes sense at each stage of the project. So next slide. So we know that the tools exist and work, and we know that the actors are eager to make a difference and to invest in projects. And despite all that, we still see many blue projects that still struggle to get finance. Why? So I want to say here that the gap is not financial scarcity. The money is there. The gap is more in the capacity of absorption. So what do I mean by that? The capital exists, but what is often missing is the ability to turn priorities of the project into finance-ready uses of capital. So let me repeat that. So the gap in the middle is not mainly about a lack of money. It's about the difficulty of translating needs into finance that can actually be deployed. So this is why many blue projects still stall, not because they are unimportant, but because the conditions to absorb finance are not fully in place. So how do we bridge that gap? The next slide, please. Right, so what really helps to bring the gap in practice and what we see is readiness, right? Readiness is what connects policy ambition to fundable projects. So it's not about doing more studies, it's really about making finance work for your projects, right? Make it finance usable. And that readiness rests on three pillars. The first one is institution, then strategies, and then skills. So institution is really, the role of institution is really to clarify who has the mandate to decide, contracts, and implement. Then we also need to strengthen strategic frameworks and create really high-level plans that will guide climate action into investment. We need to know where to go and how to get there. And then finally, we need to do a lot of capacity building. We need to make sure that the skills are there so that project can be prepared, structured, and delivered in a way that capital providers can engage with. So again, when we see all these three elements in place, we see that the financial tools become more usable. And when they are not, sure, again, the capital may exist, but it tends to reach only that small set of familiar, low-risk investments. So in that sense, the blue finance gap is often less a funding gap and more a readiness gap. Next slide, please. Thank you. So if we know that readiness is what helps bridge the finance gap, the next question you're going to ask me is, what does a fundable project looks like? Well, fundability usually rests on three things. The first one is relevance, right? We need the projects to have a clear problem, a clear scope, because capital providers, investors need to understand what issue is being addressed, why it matters, and whether it can be addressed at a meaningful scale, right? Small pilots can be useful, but if you want to have a really investable project, what investors are looking at is scalability. Then we need to have measurability, right? Blue projects very often deliver on an environmental or social benefits, but those benefits need to be defined and tracked. Investors and lenders need clarity on what success looks like. So the key here is to have measurable outcomes that we can replicate for all the different projects. And third is credibility. So this is about delivery and governance, and this is something that everybody can connect with. I see that the time is running, so I'm going to skip on that. I just want to say that there is a very important cross-cutting part of making a project investable. It's what we call de-risking, right? So it's not removing the risk, but it's reshaping them so that it matches what different sources of capital can accept. So we can de-risk projects usually in two different ways. The first way is to lower the risk, or we can improve the return profile of a project. So lowering the risk means usually using concessional funds or first loss capital that will absorb early losses. And it can also mean deploying, guaranteed or insurance that can cover specific risk. So, and the second way to de-risk a project is by improving the return profile of that project. And that can mean involving, again, concessional loans or blending equity. So in practice, this is where a strong and sound funding strategy becomes critical, right? Because it helps decide how the different tools can be combined and sequenced over the lifetime of a project to make it more fundable. I wanted to ask Yaeli, do we have the time to go into the blue bond example, or do you want to skip that part?
We can go into that and then just have
Perfect.
nice follow-up questions. Thank you.
Perfect, thank you. All right, so we talked about actors, tool, and readiness, and what makes a project fundable. I've been working a lot with Blue Bond recently, right? They're having a little bit of a moment right now. And so I wanted to use blue bonds as a concrete example here. So just briefly, what is a blue bond? So a blue bond is essentially a way for public authorities to borrow money, right? It's very simple. The money is then invested in different projects, and the public authority repay the money over time with interest to the investors. So it's really a common way for governments to finance large infrastructure like road, ports, or energy system. It's been used for many, many years. And the blue bond works exactly in the same way. And what makes it blue is how the money is used and governed, right? So on the slide here, you can see the process step by step of how a blue bond works. So first, you're going to have the issuer, usually a government or a public authority, that will define the need. So they will identify which coastal or marine priorities need financing. Once we have those needs identified, the second step is to design a framework that sets the rules to define what qualifies as an eligible blue project, how the project will be selected, and how the funds will be tracked and reported. So we create the framework, we create the rules for that blue bond. Then the third step is to raise the capital. An investor will provide the upfront money to buy the bond based on the credibility of the issuer and the framework, the rules that we just set. And then finally, the funds of the blue bond will be allocated to the approved blue projects, and the progress are reported over time. So an important point I wanted to make here is that a blue bond is not about financing one single project, right? It is about creating a structured way to finance really a portfolio of coastal and marine projects under a specific framework. Think about a cluster, a pipeline of projects to be financed. Next slide, please. So what does it all mean in practice? Well, what I see again and again in the field is that when the bonds are well structured and when these issuers are credible and the frameworks are clear, the demand often exceeds supply. So bonds are frequently oversubscribed. So that's a useful signal to say that the capital is there and is actively looking for structured opportunity to be deployed, and that the bottleneck is often readiness, not money. So the key takeaway here is that the gap looks differently depending on who you are. So for public issuers like governments and port authorities, the gap will show up when priorities are clear, but the projects are not ready to absorb finance. They're not structured in the way that they can absorb finance. This means that governments' timeline or pipelines of projects to be financed by the blue bonds are not fully aligned. For investors and lenders on the other side, the issue is different. So they are often willing to engage, but only when the risk is clearly structured and responsibilities are well defined and the delivery capacity is really credible. And so again, that's why it's crucial to work on de-risking strategies to make sure that we can attract more investors. And for project developers, this is where it becomes really concrete, right? Technically and environmentally sound project can still struggle because they have not been translated into something that capital providers can engage with. So upstream of the project, we have to think about how we can structure that project. And a lot of my work sits exactly in that space, right? Taking coastal and marine priorities and help translate them into finance-ready projects and portfolios that can actually use the tools we have for the blue finance, whether it's loan, guarantee, or bonds. So in practice, really blue finance is not about finding new money. It's about doing the translation work that will allow capital and institutions and projects to line up. And I think that's the end of my presentation. Thank you.
Thank you very much, Catherine. We're running a bit late, so we'll have one discussion question for the three of you. You can take turns answering because I'm sure people need to finish up. So one question that was asked a bit differently but by a few participants is, when we talk about nature and biodiversity credits today, the focus is often on restoration projects and nature-based solutions. Looking ahead, do you expect the market to develop multiple clearly defined methodologies, similar to how the carbon market has evolved with standards like Vera, where regenerative or nature-inclusive infrastructure could become one of those methodologies? Catherine, you can go first because you're already here.
It's a very interesting question, and I think it's a little bit tricky, and I don't think we want to rush it, right? We see that already for the biodiversity credits, there is a lot of hesitation just because it's so complex, right? How do you measure a proper biodiversity credit? It's so intricate and so complicated, right? That you have to look at all those different parameters that enter into a proper biodiversity credit. But I think that one will have a better understanding of what it entails. It could very well be used not only for restoration project, but a whole different section of different projects, maybe with the same, maybe even with the same methodology. Simas, what do you think?
Yeah, well, it's no silver bullets, no single answer. I think all these carbon standards, the big ones, are addressing biodiversity or nature credits directly as well themselves, and it will continue. It will continue evolving, and I'm blanking. Could you remind me exactly of the question?
So when we talk about the nature and biodiversity credits compared to the carbon markets, we look at restoration or nature-based solutions. And when we look ahead, do we expect to see multiple methodologies and standards, kind of like we see in the carbon markets? And if we think that regenerative or nature-inclusive infrastructure could one day become one of those methodologies.
Yeah, well, that is definitely a possibility. Right now, we're seeing an explosion of different, we call it credit schemes, but it's basically different standards and methodologies within these standards, or separate methodologies that then could be rolled into standards now being developed. And we need to agree on the core definitions, units, activities, claims, etc. Once that's the case, this principle can be applied across different ecosystems and different, let's say, geographies, activities, etc. So I don't see why that would be any different. But there's just a lot of conceptual, foundational, let's say, things to be fixed first, and that is why we're personally very excited about the EU taking this seriously and really looking in how they could play a part in this market. And this will not just be EU, let's say, like the effects of the work that the EU does will not be limited to the EU, and one block or a block that makes a precedent might then have effects to the rest of the world. And maybe we'll have a set of indicators, and maybe we'll have a unit, maybe we'll have few key pillars everyone agrees on, and then we will build on the rest. At the moment, it's an explosion of innovation. Everyone is incentivized to have their own, let's say, their own way to interpret biodiversity credits. So we're not incentivized actually to build a unified market. We need someone to do that. But once that's the case, I don't see how it can be different from, or how it would be that much different from carbon. In fact, a lot of ecosystems cannot be, for example, be funded purely through carbon, and a lot of project developers are looking to supplement their income from both carbon and biodiversity. Even carbon-rich ecosystems like peatlands, for example, an ecosystem that is our priority for the project at the EU level, a lot of them are not fundable just through carbon credits. That's why they're looking into nature and biodiversity credits. So I think these two structures and these two markets can play together very well to increase the pie and make sure more restoration and preservation happens.
Thank you. Ruth, do you have anything to add?
Yeah, I would have to be tempted to chime in on this as well. And I have to say, working quite extensively on carbon markets, I would say that there is not really an urgent need to create more rules and frameworks, and it would be nice to have less. And I think that specifically considering the characteristics, the specific attributes of nature and biodiversity activities, there's not necessarily a need, in my view, to create methodologies. There can be, for example, the VCS program under VERA. It is a set of high-level principles, and there are various programs created within that framework that set the rules. And then you have the methodologies, and then you have the specific projects. So I think probably the methodology layer of it, because nature and biodiversity projects are so highly characterized by the specific attributes and factors relating to that specific area that can't really be replicated in other places and are very unique. I don't see it as a necessity on having the methodology layer necessarily. It can be there, but I think that it might be very well the case that a set of principles, high-level principles and standard, and most importantly, the measurement methods that are accredited and reliable, once those are in place, then you can really move forward to the project level.
Thank you. I wish we had more time for more discussion questions, because it is interesting to see the different point of view each one of you has. But from the presentations and the discussions, we see that there's an emerging trend pointing to a clear direction, that projects that can demonstrate measurable, reliable biodiversity outcomes are better positioned to reduce the risk, unlock financing, and accelerate investment across marine and offshore sectors. I want to thank you again, all our speakers, for joining us and sharing your insights. And thank you everyone who joined the webinar and taken part in it. And all the questions that we didn't have time to answer will be answered in a follow-up email together with the recording of this webinar. So thank you everyone. It was a real pleasure hosting you all, and I hope to see you again soon.